Thanks, Tom. And so before I start, I want to thank you all for attending this conference. And my research area is in community banking, and I have always been looking forward to situations like this. I can get really comments from the community bankers. So I work for the board, so the usual this disclaimer applies. So the views are all mine, and they don't represent any of the Federal Reserve System. So the introduction of this paper. So basically, I focus on the small local banks, and because they play a very important role in the American economy by providing essential credit to the economy, especially for the small businesses and in the rural areas. And we all know that those banks could also be very vulnerable to regional shocks. A crucial lesson we learned from the crisis is basically a lot of banks, they subject to regional economic shocks and therefore end up failed. So the question is, a decade later, given all this economic growth and regulations and tighter supervisions, do we see that those banks are able to weather the storm better? And a related question, because those banks have been concentrated in certain areas, and we saw from Governor Bowman's speech earlier that there has been a lot of merger acquisitions going on. So the small banks have also been expanding their geographic scope over time in the post-crisis period. So the flipping side of that is, do those banks actually transmit the shocks from one region to another, more so than compared to prior to the crisis? So this paper, in a nutshell, asks the question, what is the role of bank branching networks in propagating the shocks from one economic area to another? And the focal point here is the small banks. And to illustrate the idea in a very straightforward, simplified manner, so I have one bank here, small bank A has two branches. One branch operating in County A, and the other branch operates in County B. So they are doing this traditional business by taking deposits and lend it out. And the only difference between County A and the County B is that so County A has a lot of oil production facilities. So you can think about some counties in Oklahoma. So in recent years, they have been involved in shale gas or oil productions. Whereas another county, also in a rural area, they do not have a significant concentration of that business. Now the question I ask is, what happened if there is an oil price collapse that affecting the whole economy, but specifically is a negative shock to the County A, and how does it affect the system? So because I'm going to talk about this setting, right? So our oil price, this is very important to say why this is very unique. So I think this oil shock is very unique because this is one of the few, I would say this is the one major shock during the post-crisis year that happened particularly in one region of the economy. So let's look at the real GDP growth in the post-crisis period is pretty much trending up constantly. Whereas if we look at the oil price, there is this dramatic decrease in the oil price in the end of 2014 from about $100 a barrel to less than $50 a barrel. So this is significant because during half a year of time, and the oil price has declined that much, meaning that the small producers that pretty much their loans is tied up to the covenants of their cash flows will be very much affected by this decline in the revenue and cash flow, and therefore be constrained for their access to the financings. And so in a nutshell, there are three major questions that I aim to answer in this research. So first, does the collapse of oil price cause stress to to the small bank A. And because the focal point is, again, the smaller banks, I want to know whether they are able to weather the storm better. So I look at internally, how do they handle this liquidity drainage? Do they actually sell the less liquid asset first, or do they sell the most liquid asset first? And relatedly, important question is, do they actually transmit the shocks from one area to another through their branching networks? So basically look at what happened to the branch B of Bank A in county B, in another county. There is no significant exposure of oil and gas industries. So a summary of the findings, basically I find that banks were exposed to the oil shock through their operations in the local counties. Actually, they documented a significant drop in the demand deposits into those banks. And also, simultaneously, I observed that there is significant increase in the percentage of troubled loans that held by those banks. Because they mostly lend to the local borrowers, and then you would imagine that the oil shock is essentially not only affecting the deposit intaking, but also the loan default at the same time. So, secondly, I observed that these banks sold a significant amount of assets to replenish the liquidity shortfalls, and in particular, I found that there is a decline in holding of the most liquid asset. So very much similar to what happened in the last crisis. So those banks got rid of the most liquid asset first. I'll be talking about that in a minute, of the reason behind it. So last but not least, I find that the banks were able to transmit the shocks, negative shocks, through their branching networks to another region. And this is very much prominent especially for the cases when those banks are smaller in size and held illiquid assets compared to the larger ones. So the data I use from a few sources, but quite standard. So I collected the condition of the banks from the call report, so FFIEC report of income and conditions, that's quarterly data. And I supplement this data with small business loan data from CRA, which is used by many researchers, I guess already covered earlier. And I basically identify the bank's branch locations using the FDIC summer deposit data. So that gives you an idea about where the locations are, which are the locations that are not ATMs. So you're able to see where they're really like deposit intaking or loan making branches. And in the end, I also control for a bunch of different factors. Local economic trends and political economics factors that try to make sure that the result is clean and to the point. So apparently the most important thing for this research is to identify banks' exposure to the oil price. How do I do that? So apparently the payroll deposit is one of the most important sources for the local banks operating in the rural areas. So first job is to identify these areas where there is a lot of oil and gas producers, and when there is oil price hit these areas, and then the banks will expect there is less amount of payroll deposit into the banks, and based on the locations of the branches, I will be able to identify the banks that are most exposed to those shocks. To the oil shocks. So show it geographically, you can see that I have a figure here that shows a percentage of payrolls that, per county that comes from the oil and gas industries in 2014. And essentially here, I primarily only focus on the oil production industries because the story is more about oil price drops. So you see that those production counties, fit into our daily assumptions that will be in Dakotas, western part of Texas, and so these areas are very much dependent on this oil and gas industry. And so the first result, I want to look at what happened inside the banks. So basically, after the oil price collapsed, right? So I look at the kind of banks that are most exposed to the shocks, and I find that first the demand deposit decreased significantly, together with a higher interest payment on those deposits, because now there's apparently a competition going on in the deposit market. If you have a lower amount of deposit coming in, you want to increase the margin you paid on those deposits. So at the same time, thinking about the bad loans, right? So what happened to the bad loans? Because now for the past bad loans, we can sort of see it through charge-offs, right? So they charge off the bad loans, but also because banks are so concerned about this oil price, so oil price collapse. So they also provision more for the future. So indicating that they think this oil shock will be there for a while at least, and the effect is pretty significant. And I further look at what happened to their asset holdings. And now, this part I found very interesting because during the crisis, we found that, including mutual funds studies, they show that mutual fund managers, they sell the most liquid asset first because they try to avoid this liquidity discount. But now we're looking at a period where the economy is going up in general, so there shouldn't be much of a liquidity discount, if any. So, I mean, if a bank actually needs some liquidity, maybe it's also the time to sell some of the less liquid asset. But that's not the finding here. So here, actually, we find that the banks, they still sell the most liquid asset. They get rid of the most liquid asset first. And the less liquid asset, the result is not very significant there. So the next question, so the final question I want to ask is, what about the transmissions? Because of all these mergers and acquisitions happening in the post-crisis era, do we see that banks actually able to transmit the negative economic shocks from the oil-producing counties to the non-oil-producing counties? So essentially, I look at the small business lending, and I also look at the mortgage loans, because those are the two major lending business conducted by the small banks in these areas. And I find that they are transmitting the negative shocks across economic regions. And the effect is also economically significant. So on average, each exposed bank branch decreased the lending to small businesses in non-exposed counties by $1 million or so every year afterwards. Notice that this is only the average, and then this picture shows you that basically in certain areas the effect is really strong. That the decline in the exposed banks' SME lending has declined even like over 40% in certain areas. That means a lot to the local businesses. Of course, when we talk about the banking studies, I have to be careful about this demand and supply. Although I have control for, the county and time fixed effect that's supposed to capture the trend happened in each county, I still want to make sure that there is some supply story going on. So here, I look at the mortgage lending. I look at the amount of mortgage loan originated, as well as the approval rate. So we see that a double down here. So basically, both measures, we saw a decline in the amount of mortgage originated, and also the approval rate have declined significantly. So further result shows that the effect is stronger if the banks, they don't have a local community tie. So essentially, if they don't have a local branch operating there in the local county, they are decreasing the supply even further. So which makes sense, in accordance to the story about this community links from the local banks to the local communities. And the effect is also stronger for the smaller ones, which are arguably more vulnerable. So in conclude, I think it's very important to think about in a post-crisis era how resilient are the smaller banks and whether they are able to transmit the economic shocks throughout different regions. And I think the implications are very interesting. So I think now we have lots of regulations and capital helps for the big banks, but there's not a lot of discussion going on about liquidity help to the small banks when they need one, right? So maybe it's a time to think about that, and in addition to the LCR and all that discussion. So one caveat here is that I use the aggregate data, so the analysis is only based on the banks that report to those data, and maybe on aggregate the effect is actually captured. The negative shocks is mitigated by some competitors. So that is not shown here, but I think further research might be guaranteed in providing more evidence on this issue. Thank you.